right, welcome. People are flooding in. It's always beautiful. So we'll get started in, let's call it 1 minute to stay on time as people are joining. Why they are joining. You're doing all right, Mike?
Yeah, everything is fine. Keeping busy.
Good. Well, I'll start with just a nice light introduction here while we wait. So for those who are hopping in, we have Michael Salad here, who is a partner at Cooper Levinson Law Firm, a firm we do a lot of work with. We love these guys. We are not affiliated with them, but they are good friends of Diversified and our clients. So for those that don't know me, I'm the president of Diversified, Andrew Rosen, and I'm going to introduce Michael here. Again, today's topic is estate planning with life insurance. We will send this around to all our clients, so feel free to share with whomever. Additionally, we will take questions in the form of write-in. So just if something comes across your mind, type it in the box. I'll proctor this and I'll field the questions accordingly. So, Michael, how you doing?
I'm ready to go.
All right. Well, without further ado, why don't you kick us off?
Great. Thank you, Andrew. I appreciate the opportunity and looking forward to chatting with everyone. I enjoy when these sessions are interactive. So if anybody has questions along the way, I'll be glad to stay afterward as well. And also anyone is free to contact me afterward. I'll have all my contact information on the last slide. And I enjoy being challenged, as Andrew knows, and I enjoy questions. So please feel free to take advantage of that at any point, either now or after the presentation. Going to focus on life insurance today, but I want to give a brief primer on the current estate planning tax laws as they stand today, because it will impact the presentation and a lot of the planning alternatives that I'm going to recommend. We currently have a federal estate tax of 40%, but it is only on assets that exceed a little over $12 million per person. And if you are married, there is portability, creating in excess of $24 million of exemption from estate tax. The estate tax is all of your assets comprised together. And if that amount exceeds $12 million, then that 40% tax will be implicated. There is also in 12 states, as well as the District of Columbia, a state estate tax or inheritance tax. So that is also something, depending on where you are located, that should be considered and contemplated in your plan. There is also a gift tax, and the gift tax is also implicated for gifts in excess of $12 million. But each year you may gift up to $16,000 per person to as many people as you want. So I can give to everybody on this meeting here $16,000 each. It's not a total of $16,000. You can only gift one person $16,000 in any given year without eating into your $12 million lifetime gift tax exemption. The reason that this is important, while you may or may not be at those levels, a lot of our clients are unfortunately not quite there, there is a provision in the law that enacted this $12 million exemption that sunsets at the end of 2025. So on December 31, 2025, that law will end, and starting on January 1, 2026, unless Congress acts and changes the law, that amount will go back to its 2017 levels when it was enacted into law, and it'll be roughly $5 million. Adjusted for inflation, we estimate it'll be closer to $6 million. Why is this important, you may ask? Well, it is important when you encounter life insurance. I'm going to go to the first slide here, and I'm going to, right off the bat, bust a couple of myths. One of the most common myths that I hear is that, well, if I own life insurance, there's no taxes. Well, that's not exactly correct. There are no taxes on income. So if you receive the, say, $1 million life insurance policy, it will be free of income tax under Section 101 of the Internal Revenue Code. But that will not exempt you or the beneficiaries of your estate from estate tax. So when I started practicing in 2011, there was a much lower exemption. It was closer, I think it was about $5 million. And so if you, and say you're married, you have a spouse, and you each have $1 million or $2 million of life insurance, now suddenly there's $4 million. And if you have $1 million of assets, either your home or bank accounts, et cetera, you're now suddenly at that threshold. And when you include group life insurance policies, when you include things like standalone policies, accidental death dismemberment policies, you can quickly get to those thresholds. And with the horizon of the sunsetting in 2025, it is much more important that we revisit these issues now and start thinking about it. And the reason that we want to start revisiting them now is because there is a 3-year look back period from when you transfer a policy into what's called an irrevocable life insurance trust. We commonly refer to this as an ILIT. And the biggest issue is that people will have existing policies that they transfer, life insurance policies that they transfer into this irrevocable life insurance trust after they've acquired the policy. And when you do that, it implicates this 3-year look back period, meaning if you pass away within 3 years after you transfer that policy into the irrevocable life insurance trust, then it is subject to estate tax. If you acquire a policy in the name of the ILIT, so you decide tomorrow you're going to acquire $1 million term life insurance policy, and you set up an ILIT, and that ILIT will then become the owner of the policy when you acquire it, there is no 3-year look back period. So we are discussing these concepts now. It is a very, very popular topic at this moment, considering the potential changes in the coming years, and because it is in general good planning to use an irrevocable life insurance trust. So when I was initially using these concepts in irrevocable life insurance trust going back 10, 11, 12 years ago, when I started practicing, we used an ILIT almost every single time someone acquired a life insurance policy for the reason that I described. Because the exemption amount was much lower and you start including the insurance premium, the insurance beneficiary, the policy distributions after someone passes away, it quickly would add up. And as those amounts increased, one point, Andrew, as Andrew does very well, stopped me and he said, you know, why are we doing this? Now the exemption amount is $12 million. Do we really need to be doing this? Why not use a trust that we create within a will as a beneficiary? Or why not use the revocable trust that you've set up for them as part of an estate plan as the beneficiary? Why do we have to go through this process of a separate irrevocable life insurance trust? And I remember this discussion, Andrew, you may or may not, but you don't see things as they are. And you stopped me and you said, wait, this exemption amount is a lot higher now. Why do we need to do it? And it was a very good question. And it is a question that many of you may have. The reason that you don't want to name, ideally, you don't want to name a trust created within a will. So you set up a last will and testament and you say, I leave everything to my spouse, or I leave everything to my children. If my children are under certain ages, I want the funds to be held for their benefit. And then you name the trust within that will, it's called a testamentary trust, as the beneficiary of your life insurance policy. Then you change your will in the future, as many people do, it invalidates that designation, that beneficiary designation. So now the assets pass through your estate to the beneficiaries and are going to be subject to that estate tax as well as potentially other taxes. So we generally don't like to appoint a testamentary trust, a trust created within a will, as the beneficiary of a life insurance policy because of the commonality in the frequency in which people will often update their wills, and then you need to update beneficiary designations and they forget. A revocable trust is a very common instrument that we use for probably not the majority, but a lot, overwhelming number of our estate planning clients to avoid probate. And it is a good tool and it works well for probate avoidance, but because it is revocable, it does not provide any asset protection and it will not avoid estate taxes. So the irrevocable life insurance trust, because it is irrevocable, you are giving up certain what's called incidents of ownership. That's a term of art used in the legal world. And by making it irrevocable, meaning you cannot change the terms, and naming somebody else to control it, called the trustee, you are giving up what's called incidents of ownership from the policy proceeds. And because of that, in return, you now get the tax avoidance and other creditor protections that would not be afforded to, say, a revocable trust or just naming a beneficiary. So with that, I'd like to, unless Andrew, you have anything you want to interview, I know you're monitoring questions.
No, someone raised their hand
for a second.
Someone raised their hand, but a quick reminder, I think, for everyone is just type in any questions and I'll field them there. And this should be a thing here. This is Q&A or chat. You can do it there and I'll take it. No, one thing you said earlier, Mike, I don't believe you expand upon it, which is any human has a $16,000 gift to another individual. If you're married, just a reminder that if you have 3 kids and you're married, you can give essentially $32,000 to each kid or to any entity.
Correct.
That kind of gets doubled, and it's not like you have to account for, well, it came from my checking account or my wife's or her income or my income.
That's correct. That's correct. If you are married and you make a gift, you are deemed, unless the spouse says otherwise and doesn't want to, there is a presumption that you may gift that up to $32,000 just by the mere fact that you're married. That's right. Yep. And it's a good point. So I'd like to talk about a irrevocable life insurance trust because it's one of the 2 most important concepts, in my opinion, with regard to estate planning that involves anything relating to life insurance. A irrevocable life insurance trust, again called an ILIT, has 3 primary components: a grantor, a trustee, and beneficiaries. The grantor or grantors sometimes, which we're going to discuss in a moment, is the person or the people who set up the trust. So if I purchase a life insurance policy and I decide I want to set up an irrevocable life insurance trust to own it, then the grantor would be me. I'm the person who's setting it up. The trustee is the person who's responsible for administering that trust. So that's the person who's going to be responsible for making distributions from the trust, from paying life insurance premiums. If there's a need to borrow funds, all of that would be accomplished by the trustee. And that should not, and definitely really cannot, be the grantor. You want that to be somebody else. The beneficiaries are the people who derive the benefits from it. Similarly, if you're the grantor, you shouldn't be the beneficiary because now you have instance of ownership. As the beneficiary, you now have control, you're receiving the funds. So it would not result in a estate tax exemption. So generally, you're going to provide for a spouse or children or other individuals to become the beneficiaries. One other primer is that there are a couple of different components to a life insurance policy. Generally, have the person who the policy is insuring that person's life, that's the insured. You have the owner of the policy, and then you have the beneficiary. So if I acquire that term life insurance policy that I just mentioned on my life, I am the insured. The owner, it could be me, or it could be my irrevocable life insurance trust. And then generally the beneficiary would also be the irrevocable life insurance trust if I have set it up. In addition to removing these assets from the estate so they're not subject to estate tax, it also provides a level of control over the assets that would not be afforded if you simply name a person or people as the beneficiary. If I have a term life insurance policy and I nominate my spouse, or let's say my children, as the beneficiaries, if I pass away tomorrow, those funds are going to go to my children. I have two very young children, and I definitely would not want them to receive that $1 million policy in my example outright. The ILIT will allow you to better control the disposition of those assets. You can make multiple people beneficiaries. You can set certain ages for the funds to vest. You can have certain circumstances that they have to graduate college or they have to graduate grad school, or the funds can only be used for college or other higher education. You can require a child, if you have concerns about addiction issues, to submit to testing, whether it's drug testing, alcohol testing. They have to complete certain rehab. We've had many issues with people who simply have children that spend a lot of money, spendthrifts, and we want to make sure that the funds are protected. And the number one question that I receive is, if my children are going to get married, how do I ensure that their spouse doesn't get their hands on all of my money? And that can be accomplished through an irrevocable life insurance trust to keep the funds in the bloodline. That can be accomplished in a bunch of different ways, which I don't want to get too far out of the scope of our presentation, but suffice it to say that that can be accomplished through an irrevocable life insurance trust.
Yeah, and Mike, two points there.
Sure.
One is I know at Diversified are big proponents of putting age limits in there because they can always get the assets sooner, but you can't sort of delay it if you say they get it all at 30. And life insurance can be sizable assets, and most people can't handle that at once and do spend through it. So I really encourage people to look at trust planning in any event when they have real assets. But riddle me this real quick, because I'm not sure I'm 100% sure on the answer. So owner dies, leaves their assets in an ILID. Can that ILID go purchase a family home?
Sure. If the terms of the trust permit it, and that's a goal, absolutely. You can be very broad with the funds that can be used. And generally what will happen is, go ahead.
No, I was just gonna say, and it can stay there. So if I'm concerned that my son, I don't like his wife, or she's gonna get half of the assets, or my daughter, same thing, I can say, look, you can go buy houses. This trust, you can't touch it till you're 90, but you can use it to go live, buy homes, and so on and so forth. It can do things of that nature.
Absolutely. And it's probably, I only had two myths that I'll bust, but that'll be the third one, is that an irrevocable life insurance trust can only own life insurance. And that's not the case either. We call it an ILIT. It is designed generally to hold life insurance, but it's an irrevocable trust that can generally, depending on the terms of it, but at least generally when I prepare them, is broad enough to own other assets. And it commonly does, particularly after somebody passes away. The second myth, and it is something that is more nuanced but is important, is the ILIT itself cannot be used to pay estate taxes. And most people say, oh, you set it up and the ILIT will just pay the taxes. Not exactly. The beneficiary of the policy can then use the funds to pay the taxes. The ILIT itself can't pay the taxes, but the beneficiaries can. And what also will generally happen is that there can be a swap or transfer of assets, or there can be a loan to the trust. So the proceeds come in, and now they need to use the funds to pay it. They can do some type of swap. And there's a lot of different ways that we can accomplish the goal of paying estate taxes, or if you live in a state that unfortunately also imposes an inheritance tax, it can be used to fund those types of taxes. Any questions on any of that, Andrew? Anything else before I go to the next slide? I have one other point, but then I'm going to go to the next slide.
No, go for it.
Okay. There is also a level of creditor protection. And this is very much a product of state law. So I don't want to spend much time on it because We have clients, and Andrew's clients, not only all over the country, but all over the world, with different state laws regarding creditor protection. But many states will allow an irrevocable life insurance trust to protect assets from creditor claims. There are some states that say that if you inherit funds from a life insurance policy, those funds may be protected anyway. But my concern is often if the person, the grantor, or the person who owned the insured has a creditor at the time that he or she passes away, then those funds may have to be used to pay creditor claims. Many states have laws that will exempt those creditor claims and say that they are not going to be paid from life insurance policies. But that's why this part of it is important to field on a state-by-state level. However, generally, if you have an ILIT, you will receive that creditor protection. Okay, one other point, people say, well, is this irrevocable life insurance trust too good to be true, or are there any disadvantages? The disadvantages are that it is irrevocable, so it is more difficult to change the terms. The laws are evolving now so that it used to be several years ago impossible to change the terms of an irrevocable life insurance trust. It is now very difficult, but not impossible. And you should never plan on changing the terms. If you are setting up an irrevocable life insurance trust, you should know that those terms aren't going to be changed. Now, you can always change the beneficiary. So if you have your irrevocable life insurance trust as the beneficiary, and you decide that you don't like the people you have named in the trust, you could always set up a new irrevocable life insurance trust, but then that starts the 3-year look back period. So it's a little bit of a difficult process to do that. You also lose control because the trustee is now going to have the control over the trust and be making investment decisions and distributions, et cetera. So you do lose that control. And there is a cost to set it up. You have to pay an attorney to set it up. And there generally is not a lot of maintenance year to year, but you do want to send out what's called a crummy notice, CRUMMEY, which we're going to discuss in a moment. And I have this on this slide here, where it comes from a famous case, tax court case called the Crummy case. And you can send out notices once per year to the beneficiaries of the insurance trust, the ILIT, and give them a 30-day window to receive funds that are deposited into an ILIT account. And if they do not take you up on that offer, the trustee sends it out and it says there's $5,000 in the account, you have the right to withdraw certain funds. If you don't, then those funds can be used to pay the premiums. And that's usually how this works. So generally you can kind of set that on autopilot. I know we have a software program that just generates what's called these crummy notices, but there is a bit of an administrative burden in this process. Not a big deal, but there is some of that.
Yeah.
So
And it is. I mean, I say it, it's not as easy as just paying the bill when it comes to the house. There's certainly.
Yep. And depending on the type of policy, it can become a little bit complicated, but again, nothing that is too difficult, I would say generally for the day-to-day ILITs that we deal with, it's not overly difficult. So on this slide, one of the most common products that I am seeing as an estate planning attorney day-to-day are hybrid policies, wherein there is a long-term care insurance component or rider, and there's a life insurance component. So you may have a life insurance policy that has this long-term care rider. And if you have a long-term care need, which from statistics I've seen is going to be 70% of Americans age 65 and older are going to need some type of long-term care, then the funds can be used toward that long-term care within certain parameters and certain amounts and daily or monthly amounts, depending on the policy. And if you don't need the long-term care, then the traditional life insurance policy pays out upon your death. And I'll let Andrew more discuss that as moving forward, either now or offline about that. But I'm seeing them a lot and I'm receiving a lot of questions. Well, Mike, can I put those policies into an ILIT? The answer is yes, you can, but it's a little bit nuanced here as well. The reason is that you, as the owner of the policy, you're the grantor, you set up this trust, and now you need long-term care, the ILIT cannot pay for your care directly. So if the long-term care rider kicks in and it's making those payments into the irrevocable life insurance trust, then the beneficiary of the policy needs to use the funds to pay for your care. So those that have thought this through have said to me, well, wait a minute. So use the example. I set up this irrevocable life insurance trust. It has the rider. I now need long-term care, and the proceeds are paying monthly into this trust, but they're going to say, Andrew, who's my beneficiary of the trust. So now it's not doing me any good. So now Andrew would need to use the funds that are being paid for my medical care. And that usually implicates a question, well, so now is there going to be a gift tax? Is Andrew going to be imposed a gift tax? Is that going to eat into his lifetime exemption? And the answer is no. Even though there's a $16,000 exemption amount per year, and there's that lifetime exclusion of 12 million, we wouldn't want to eat into his lifetime exclusion of 12 million, or necessarily a $16,000 gift if he wants to make other gifts to me or whomever. There is a carve out that says that if the funds are used for medical purposes, and that is a defined term, there's an unlimited amount of funds that can be used for medical purposes. So it is not an issue there, but you need to rely upon your beneficiaries to make those payments on your behalf for your coverage. So it's not a perfect system, but in summary, yes, a hybrid long-term care life insurance policy can be owned by an ILIT, and many times there are benefits to doing so.
So you don't want to make it the kid that's going to off you.
That's right. Exactly right. We want to definitely be thoughtful in that. I'm going to skip a couple of slides. A seconded I policy in simplest terms can absolutely be owned by a life insurance trust. We would have, I mentioned in the beginning, you may have two grantors. You can have spouses that serve as the grantors of the trust. Then you have others that serve as trustees. And you can have, say, children or other beneficiaries as the named beneficiaries within the ILIT. But yet the answer in general is a seconded I policy can be owned by an irrevocable life insurance trust. The last element that I'd like to discuss, I see we only have a couple minutes and I want to leave time for questions, that we most commonly use a life insurance policy and planning are those that are in the business world. And they have one or more partners or shareholders or members in the case of an LLC. And there are a couple of ways that they can be used. Let's say Andrew and I are in business together. We form an LLC. It's called the Salad Rosen LLC. And I'm seeing a little bit of gray hair in Andrew. And I say, you know what, I'm a little worried here. What happens if you die? And then now what? And the answer is generally that you have a buy-sell agreement. And it says that I would be required to purchase Andrew's interest in the company, in Salad Rosen LLC, from his estate when he passes away. But let's say I don't have the cash available to do that. We will most commonly use life insurance to fund it. And you will see in my first bullet point here, I have cross-purchase versus redemption. In a cross-purchase agreement, I will acquire a policy on Andrew's life. I'm the owner of that policy. He's the insured, and I'm the beneficiary. Andrew gets hit by a bus, and now I receive, say, $1 million, and now I can use that $1 million to buy out his estate in the LLC. A redemption is used when a company redeems the interest. So in my example, we'll say the other way. Now I pass away, Andrew's still alive, but Salad Rosen LLC owns the insurance and redeems the policy. In its simplest terms, if there are only two partners or members or shareholders, we generally prefer a cross-purchase agreement because there are tax advantages to doing so. If there's more than two partners or members or shareholders, we'll generally prefer redemption because now let's say that Andrew and Sarah and I are the three members of that LLC. Now I need to acquire two policies, and he needs to acquire two policies, and Sarah needs to acquire two policies. It can become unruly. So we'll have the company acquire those policies, and redemption is usually an easier format. And the same would apply for disability. If Andrew becomes disabled and he's no longer able to operate the business, we may want to have a disability policy that works in the same manner. So I'm going to pause there, and maybe we take some questions either from you or anybody else.
No, I think in the interest of time and trying to end on time, this was extremely thorough, Mike. I think it was very educational. Anyone that has questions, shoot me, Dave, Kyle, any of the advisors here. We can make an introduction to Michael if there's something you need help with, or answer questions. He's a friend, as I stated when I began. He's a friend at Diversified and happy to give guidance or any thoughts. And then here's his contact information if you want to reach out to him directly. But thank you, Michael. We do these every month or two to inform our client base on different relevant topics with different industry experts. I hope you all enjoyed it. And I'm Andrew Rosen. So signing off. Thanks, Michael.
Thank you very much. And I'll look at the questions and we'll make sure we respond to anybody
Great.
who posed them.
Thanks so much. Thank you for joining, everyone. Bye.